Sime Darby has put its plans to spin off its healthcare unit on the backburner, according to Group CEO Datuk Jeffrey Salim Davidson. However, he did not elaborate on the reason for the delay, only that the group is looking for various opportunities to grow the healthcare business, he said during Sime Darby's second quarter FY22 briefing. To recap, in October 2020, Sime Darby said it was mulling the listing of its joint venture healthcare unit, Ramsay Sime Darby Healthcare, which it holds with Australia's Ramsay Healthcare. Sime Darby saw its net profit for the second quarter almost half year on year to 345 million compared with the 633 million posted in last year's corresponding quarter. This was due to the absence of a one-off gain of 272 million from the divestment of the group's stake in Tesco Malaysia that was reflected in the second quarter of FY21. However, core net profit for the second quarter was still 4.4% lower, due largely to the lower profits from the industrial division's China and Australasia operations. Revenue for the quarter fell 6.3% to 10.54 billion ringgit. The group declared a first interim dividend of 4 cents per share, 33% lower than the same time last year. It was a similar scenario for the first half, where net profit shrank 36.4% to 581 million. Core net profit dropped 8.2%, again due to a lower contribution from the industrial division, while revenue declined 4% year-on-year to 21.2 billion from 22.1 billion ringgit. Jeffrey says that even after stripping out the Tesco sale, the group was still able to deliver resilient results despite tough market conditions. He says this is testament to Sime Darby's strong foundation and effective strategies. On its prospects, the group warns that the rising number of COVID-19 cases may still pose a risk to its operations in the near term. Noting that the heavy equipment market in China is expected to contract, Sime Darby says this is mitigated by the expected strong equipment deliveries in Australasia, driven by strong coal prices and fiscal stimulus policies. Demand for luxury vehicles is likely to remain strong, particularly in China, although supply constraints will continue to impact availability. This is expected to be partly mitigated by the higher vehicle margins as a result of lower discounting. Serba Dinamik Holdings had on Wednesday argued at the High Court that the appointment of its special auditor, Ernst & Young Consulting, to conduct a special independent review should be declared null and void, as the firm does not fit the definition of an auditor. The beleaguered oil and gas company said, therefore, due to questions surrounding EY Consulting's status, the firm should be granted an injunction from releasing the fact-finding update and other updates regarding Serba Dinamik to Bursa Malaysia Securities or indeed to other regulatory authorities. Its counsel, Mat Ling Kum, argued before Justice Dato' Ahmad Fairuz Zainul Abidin in online proceedings that EY Consulting does not fall within paragraph 2.24 of the main market listing requirements meaning of auditor when the consulting firm was engaged in July 2021. Mat says EY Consulting misrepresented itself as an auditor with the meaning of paragraph 2.24 of the MMLR. He adds that while Ernst & Young is a recognized auditor, EY Consulting is not, and as such, Serba Dinamik contends that it should not be allowed to reveal the FFU and other findings in the first place. EY Consulting's counsel, Gopan Srinavesan, argued that Serba Dinamik had known from the day its client was appointed that Muhammad Shahrizal Abdul Rahim, who is a partner in EY and a registered auditor, would be doing the special audit that was required. Gopal argues that prior to the release of the FFU, there had not been any problems regarding EY Consulting's status. He further claimed that this litigation was made by Serba Dinamik due to the company not liking the contents of EY Consulting's FFU. Justice Ahmad Fairuz fixed March 8th to deliver his decision. Heineken Malaysia's net profit for the fourth quarter surged 77% to 95.85 million on the back of better sales across all its brand portfolios. Also helping numbers was better cost management and the absence of a one-off provision of 14 million in December 2020 for costs associated with its organizational restructuring exercise implemented in 2021. Revenue for the quarter improved 33% to 692.3 million as sales volume was driven by the easing of COVID-19 restrictions and earlier festival sell-in for Chinese New Year. Heineken has proposed a single-tier final dividend of 66 cents per share, which brings the total dividend for FY21 to 81 cents per share. For FY21, Heineken's net profit improved by 59% to 245.68 million, while revenue grew by 12.3% to 1.98 billion from the 1.76 billion previously. However, Heineken notes that when compared with pre-pandemic levels, both annual earnings and revenue remain below FY19, which indicates that its business is still under the recovery phase. Looking forward, Heineken says it remains cautious given the recent spike in new COVID-19 cases, continued closure of international borders resulting in lower tourist arrivals, escalating input costs, and various logistics challenges posed by the pandemic. The brewer says it will continue to adapt to the new market reality, ensuring the safety of its people, keeping a tight rein on costs, and staying focused on its strategy to accelerate its business recovery. The group also welcomes the government's stance to not increase excise duties on beers and stouts in Budget 2022, adding that any hike in excise rates would further drive illicit alcohol demand. Press Metal Aluminium Holdings share price rose to a new high on Wednesday amid escalating fears that reduced supplies from Russia would exacerbate existing shortages of the industrial metal. The aluminium smelter ended the day at 7 ringgit for a gain of 16 cents or 2.34%, giving the group a market capitalization of 56.53 billion ringgit. Aluminium prices have climbed towards multi-year highs on geopolitical fears over the situation in Ukraine. Reuters reported on Monday that a Russian invasion of Ukraine could mean sanctions against Russian companies such as Rusal, which accounts for about 5% of the global aluminium supply. Despite Russia's repeated denials that it is preparing to invade Ukraine, the industrial metals price on the London Metal Exchange hit $3,333 per ton last week, close to the record high of $3,380.15 last seen in July 2008. Year-to-date, Press Metal shares have appreciated by 23.7% or 1 ringgit 34 in absolute ringgit value. Last April, the group had undertaken a bonus issue of 4.04 billion shares on the basis of one free share for every existing share held. AirAsia and the Singapore Tourism Board has signed a memorandum of understanding to promote travels to Singapore, which the low-cost airline has identified as a key market. Under the partnership, travellers will be able to access a wide range of travel deals to Singapore through the AirAsia Super App. Capital A CEO Tan Sri Tony Fernandez says that as Southeast Asia's fastest-growing super app with a strong over-the-air platform and a wealth of data collected over 20 years, they are certain to be able to maximize the partnership and drive traffic across Southeast Asia into Singapore together. STB CEO Keith Tan says that the board is delighted to collaborate with AirAsia, which it sees as a key regional partner, as part of its efforts to support the recovery of the tourism sector. Users of the app will now be able to book tourism experiences in Singapore, such as flight and hotel packages, meals, and other experiences. Additionally, both parties will also work together to pilot digital solutions to enhance the visitor experience in Singapore, as well as exchange knowledge and insights that will help to deepen their understanding of travellers from the Southeast Asian market, such as traveller spending patterns. AirAsia and STB will also jointly promote Singapore through marketing campaigns and content partnerships.